Bloomberg FX Masterclass, brought to you by FX Pro. Trade Forex like a pro.
FX traders want to own currencies of countries where interest rates are heading higher. That's why they keep a close and constant watch on the bond market.
If you're trading FX, whether you're a short-term trader trading minute to minute or trading day to day, even week to week, you should be aware of what the bond market is doing.
The key for traders is not only watching the direction of rates and yields, but tracking where the market expects them to go.
So if one has an expectation that central bank will increase interest rates, then that's a really powerful signal to tell you that the currency will likely go up in value.
Short rates tell us about a higher rate of return today, and long-term interest rates tell us about the possibility of inflation or growth going forward. The foreign exchange market is very sensitive to short-term interest rates.
You should be aware of where those short-term yields particularly are moving, the two-year yield, which they move all the time, and that signals expectations of future interest rates in the U.S., which is probably the #1 driver of the currency market.
Since currencies are traded in pairs, traders need to pay attention not only to rates, but the difference in rates between countries. That difference, along with currency price moves, affect whether your trade is a winner.
So let's say you have a position on dollar-yen. You have bought the dollar, sold the yen. What happens is your broker at 5 p.m. every day calculates that interest rate differential. If the dollar's interest rate is higher versus the Japanese yen, which it typically is, then you earn that difference. But if your rate differential is negative, then you owe the broker the difference.
Thanks for watching Bloomberg FX Masterclass. I'm Carol Biaggi.
Bloomberg FX Masterclass, brought to you by FX Pro. Trade Forex like a pro.